Good afternoon and welcome to TechcomBank's fourth quarter and full year 2022 financial results presentation. Jens Lottner, CEO, will begin with opening remarks, and Alex McCare, CFO, will share more details of the financial results and business updates, followed by a Q&A session. Jens and Alex will present in English with live Vietnamese translation available via a separate link. We will have another call in Vietnamese tomorrow for retail investors. We expect today's presentation and Q&A to last about 90 minutes. With that, I'll turn it over to Jens to begin the presentation.
Thank you very much, and good afternoon, everyone, and thanks for joining, and wishing probably also everyone still belated and Happy New Year. Let me just start the presentation with a couple of key comments on what we've seen probably over the last quarter. And overall, I think 2022 had its very special situations. There were quite some kind of challenges when we look into the overall market when it comes to bond market, and we saw quite some tight liquidity. With that, I think we are still very happy with the results which we have achieved. And overall, the bank is roughly at 41 trillion overall TOI, so we are up 10%. And there's a combination of NII and NFI. NII was roughly around 13%, and mostly in line with actually our credit growth. And then NFI roughly at 25%, which is quite remarkable given the fact that some of our key revenue areas in the past, which were the bond business, and were quite severely affected from some of the turmoil we saw in the bond market. But in the other areas, be it by cards and foreign exchange, letter of credit, and some of the book really grew by over 50%. So overall, I think the point we are making in the past that we actually have a relatively diversified portfolio with very diversified income streams actually holds. In terms of PBT, roughly in line with the TOI growth, we are at 10%. And we have maintained our OPEX growth at 20%, which is what we had set out to do. That's the kind of trajectory we want to be on. And mostly this is still the investments we're doing in the whole digitization of our business. But there was also a lot of investments we made into marketing in order to strengthen our brand and our presence in the market, which translated to around 1 to 1.4 million new customers. In terms of even when there were negative jaws on the overall operational income side, the fact that we can actually reduce our provision expenses quite significantly then led to 10% overall profit growth. And return on assets are still quite healthy and standing at 3.2%, down from the 3.7 which we had the year beforehand. But again, most of that driven out of the headwinds which we had in the fourth quarter. So we assume that will be coming back. CASA and the CASA ratio clearly is an area we have not performed as good as we wanted to, and we will go into the details. That clearly needs to be coming back. There were some very specific reasons why we are probably not performed as well as we should. Clearly, there has been a negative impact on the overall industry, but we have been more impacted than the rest. So we will go into that, but it's very clear that this is a number and we are not content with, and which has implications also on the total performance on NII. So Alex will go deeper into that, and we'll probably also make some comments in terms of how do we intend to correct that situation. In terms of NPLs, I think still very, very healthy book. And the NPL ratio stands at 0.9%. Some of that is actually driven by kind of indirect impact from credit information center, CIC, where some people are going delinquent in other banks, and then we need to also put these into NPLs, even if they are still current with us. If you would take this out, we would actually still be stable at 0.6%, which is probably one of the strongest numbers in the overall banking system. CAR still stands very strong at 15.2%. a little bit up and compared to fourth quarter 21, which is just in sync with our overall growth strategy that we actually want to retain our earnings in order to make sure that we are having a very, very strong car, especially in these very volatile times. So I would say, and if I take the CASA side away, which, as I said, clearly is not where we want it to be, overall the numbers are actually pretty in line with what we wanted to have, and given the headwinds we have experienced, still show very clearly that we have very resilient business model, which even in difficult times can still grow and actually drive very, very attractive market returns, be it return on assets, return on equity, etc. So with that, let me hand it over to Alex to go into a little bit more detail on fourth quarter, but also the overall year, and then I will probably wrap it up with a perspective on what will happen this year. Alex.
Thank you, Jens, and good afternoon, everyone. So let me provide first an update on the macroeconomic environment. So overall, Vietnam's economy continues to show impressive resilience in spite of global challenges. GDP grew plus 8% during the year, which is at the top end of the range that we provided last quarter. Retail sales rebounded and grew 15.6%. Foreign direct investment also gained momentum and reached $22 billion. Even exports grew over the prior year, albeit at a lower pace. In short, production and demand remained strong, and the problems were more on the monetary side. The value of the dong continued to be an area of concern for the central bank. At one point during the fourth quarter, the dong was down minus 9% compared to the US dollar. And as a result, the central bank intervened, withdrawing liquidity from the banking system and increasing rates 2 times by 200 basis points in total. So this proved effective in allowing the bank, allowing the dong to recover, but it also created a liquidity and funding challenge for the banking system as a whole. So this slide illustrates what I said earlier. So basically, the gap between the loan growth and the deposit growth widened further during the fourth quarter. This resulted in a sharp increase in the loan-to-deposit ratio of the banking system, as well as an erosion of CASA balances, forcing banks to attract more deposits and pushing up funding costs. On the asset side, the repricing has not been followed at the same pace, partly under the influence of public sector banks, which have the possibility to fund themselves at a lower rate. Overall, this new environment means a period of pressure on our NIM for probably a couple of quarters. After that, and assuming that there is no further shock, we should see an improvement again, both from the pass-through of the interest rate hike to the assets, as well as the moderation of deposit rates, which has already started. With that, let's move on to a detailed review of our financial performance. So first, the financial highlights. As Jens mentioned, we finished the year with a double-digit growth of both NII and NFI, despite adverse impacts from both the higher interest rates as well as slower activity on the bond market. We saw an improvement in our NFI to TOI ratio, and as Jens mentioned, most of our efficiency metrics, be it ROA, ROE, NIM, cost-income ratio, were within our target range. Overall, we were probably 1 or 2 years ahead in terms of our progress on our strategic plan at the end of 2021, in part due to the abnormally low cost of funds, driven by the ample liquidity of the COVID pandemic. During 2022 and during the fourth quarter in particular, we had a liquidity shock in the other direction, and we had also adverse factors hitting us in our key lines of business. As a result, we had a lower growth rate clearly in 2022, and the first half of 2023 is likely to exhibit a similar pattern. However, with a longer-term perspective in mind, And if you look through the cycle, then the overall assessment is that we are still in line with the financial trajectory of our strategic plan. And finally, despite the headwinds of 2022, we continue to lead the industry in terms of the overall strength of our balance sheet from the point of view of the combination of our CASA ratio, NPL, and capital adequacy ratio. This slide shows our PBT in more details. So during the whole year, our NII, Jens mentioned it, grew by 13%. Our NFI grew by 25%, and we will look at this in more details later. The contribution of other income was impacted by the context of rising rates, which reduced the opportunities for trading gains on our debt portfolios. We also incurred higher FX swap costs on the hedging of our debt in US dollars. On recoveries, we generated 1.3 trillion of income during the year. So this shows the effectiveness of our collection processes as well as the quality of the assets held against our credit exposures. On OPEX, the trend was in line with our strategy of investing into talent, digital, and marketing. And finally, our provision expenses reduced by 27% year on year. If we focus on the fourth quarter only, then they did increase by 10% compared to 2022. However, this rate, I think, is moderate if you take into account the growth of our credit books during the period. All in all, we recorded a PBT of 4.7 trillion for the fourth quarter and 25.6 trillion for the full year, which is up 10% on 2022. So this slide gives you more insight into the growth of our NII. Looking at asset yields, you can see a significant pickup from 7.4% in Q3 to 8.2% in Q4. The impact of the asset repricing was partly offset in the previous quarters by the shift in the structure of our credit books and the rotation toward the retail and SME segments, where the spreads and also the risk-weighted assets are typically lower. In the fourth quarter, the structure of our books remained broadly stable, and as a result of that, the impact of the repricing is more visible. On funding, our deposits grew by 12% quarter on quarter, which I think is a quite satisfactory performance. And if you look at term deposits more specifically, then the growth is even more impressive. So we essentially had large net new money inflows from our customers, as well as prioritized the strengths of our funding position. With higher deposit rates and higher interbank rates, our cost of funds increased significantly during the fourth quarter. Jens mentioned it, and that's clearly one of our key areas of focus, from 2.9 to 4.1%. And this impact was compounded also by the erosion of our CASA balances. As I mentioned last quarter, our CASA balance was comparatively probably more impacted than other banks due to the profile of our customer base, the fact that it's more skewed toward the affluent and high net worth customers, where deposit positions are typically more volatile and fluctuate in line with investment opportunities. And in this respect, the fact that we had during the fourth quarter negative sentiment across both the retail bond and the bond, equity and real estate market, therefore clearly played a role. And then the consequence of that is that our NIM continued to decrease to 5.1% for the full year. As I said, we expect a period of pressure on our NIM of probably 1 or 2 quarters, and after that, we expect that the continued pass-through to the assets, as well as the easing of the tensions on the funding side, will allow our NIM to improve again. Let's look now at lending balances in a bit more details. So the main point to highlight here is the increase in our average credit yield from 8.7% in Q3 to 9.4% in Q4. This is in line with what I mentioned earlier on the progressive impact of the repricing. You can also see that our credit balances increased further by 2% quarter on quarter, primarily in the retail and wholesale bank segments. Mortgage balances increased by 4%. Therefore, our customers continue to show appetite for investment into real estate, even though the demand obviously has significantly slowed down compared to the start of the year. Otherwise, the structure of our assets remained broadly unchanged during the fourth quarter. If we compare to the previous year, then you can see that the increase in our retail segment has been very significant, and now close to 50% of our credit assets are with retail customer, which by definition allows us to be exposed to the whole spectrum of activities in the economy. It is clear, therefore, for us that our balance sheet today is a lot more diversified than it was 12 months ago. This slide presents a view of our credit exposures by sector and product. So the most notable movement here continues to be the increase in our credit card balances of 14% in the fourth quarter and 76% for the full year. So this trend is a consequence of the investments that we have made in the digitization of our card platform across underwriting, distribution, and limit management. So we aim to continue to grow this business, which is already making a material contribution across both fee income as well as NII, and will support also our NIM going forward. Now a quick focus on deposits. So clearly growing again our CASA balances and restoring the competitive advantage that we had on the cost of funds is one of our top priorities. There are several reasons for hoping that 2023 will present a different picture compared to 2022. First, deposits should grow at a much faster rate in 2023 in the overall banking system, as the SBV buys more FX, as SBV also provides more support to the banking sector, and also as the government increases its spending. And then looking at TCB specifically, and the stability issues we had on our app, which held us back in 2022, have now been solved, and we have one of the best apps in the market based on customer surveys. We also have a new and promising partnerships with Masan, which we will continue to build out during the year and which will support our acquisition of customers at scale. Similarly, in business banking, our focus on SME segment and our merchant acquisition strategy, which should allow us to expand our deposit base quite significantly. So all this supports our ambition to increase our market share again on CASA and driving lower cost of fund. Let's now spend a bit of time on our fee income. So the bank, as you know, has shown a very robust performance in these areas throughout the year, and this despite all the adverse factors which have impacted our key lines of business, particularly in the bond and real estate market. So I will quickly go through a few highlights. Letters of credit, cash, and settlement fees were up 135% year on year, and FX sales were up 75% year on year. We made significant investments in those areas, digitizing our processes, rolling out innovative propositions for FX and trade, and launching a new app for our SME customers. Cards were up 84% year on year on the back of revamped customer propositions and strengthened merchant partnerships. We finished the year as the #1 bank in Vietnam for payment volumes across all card types. Banca was up 12% year on year. In our target segment of affluent customers, then we managed to grow our annual premium equivalent by 57% year on year. Finally, and that's the weak spot in our performance, IB fees went down by 28% year on year in a context of weaker investor sentiment, regulatory tightening, and public investigations into the bond and real estate market. So all these factors clearly led to lower trading and advisory activities and impacted the volumes as well as the margins of our IB business. Looking ahead, we welcome the regulatory changes, even if they translate into short-term pain, and we remain confident in the strengths of our business model and also in our capacity to capture the opportunity entailed in the development of Vietnam's stock exchange. Let's now look at our operating costs in a bit more details. So as in previous years, we had an increase in the cost run rate in the fourth quarter. And this has to do with the usual seasonality linked to year-end accrual true-ups as well as annual disbursements. But then this year we had also two additional factors. So first, a catch-up on the amortization of new platforms which went live during 2022. And this explains the spike in depreciation. And then secondly, an acceleration of our marketing expenses. During the first part of the year, we spent below our targeted budget on marketing, in part as a consequence of the stability issues that we had on our app. And then the increase in Q4 is therefore primarily about catching up with our plan, as well as creating momentum ahead of the new year. Cost in the first quarter 23 will therefore be back to the normal run rate. Overall, looking at the cumulated positions since the start of the year, then the growth rate on our cost was roughly 20% year on year, which is the same rate as the one we observed in the previous quarters. Our cost trajectory overall reflects our priority to invest into marketing and technology and is in line with our strategic plan. A quick focus now on asset quality metrics. So credit costs on a last 12 months basis remain broadly stable at 0.3% of loan balances. And after recoveries, credit cost was exactly 0%. So we benefited in 2022 actually from the reversal of the provisions made previously during the COVID pandemic. Our NPL increased in the fourth quarter, as you probably noticed. So most of this was in our TCBS subsidiary as a result of our policy to classify margin lending exposures as NPL when they do not meet our LTV criteria. However, in TCBS books, these loans remain current, and the expectation at this stage is that the bank will not incur losses as a result of these exposures. And if we focus on the bank only, Jens mentioned it, and if we leave aside the impact of the credit bureau, then our NPL was stable below 0.6%, which is one of the lowest levels in the industry. Restructured loan balances continue to run off to just 0.4 trillion or 0.1% of our total loan portfolio in Q4. Most of our customers were able to exit the COVID support program or repay their loans. Turning now to capital and liquidity. So during Q4, we added another 3.7 trillion dong to our capital base. Our CAR reduced slightly to 15.2% as a result of asset formation. It was still up 20 basis points since the start of the year. On liquidity, our funding mix improved. Jens alluded to it. We had a higher proportion of customer deposits, and as a result, our regulatory ratios also strengthened, remain broadly stable and comfortably below the regulatory limits. Finally, a glimpse into our performance compared to our peers at the end of the third quarter. We can see that TCB increased its lead in terms of cost efficiency and asset book performance during the third quarter. However, our lead on cost of funds and NIM reduced a bit, linked to the context we discussed earlier. So to repeat our view, growing again our CASA balances and improving our NIM are two very important objectives for us. However, we also acknowledge that the environment remains volatile and that improvements will therefore take time to materialize, probably a couple of quarters, at least for NIM. And this is primarily because of the continued repricing of our term deposits in a context where the pass-through to the assets follows with a slight lag. We will turn now to the projections for the year ahead. So as you can see, we expect the GDP in 2023 to be around 6% in terms of growth, supported by the continued rebound of the tourism, particularly from China, and by the increase in public spending. This is the most likely scenario. Obviously, we can also think of more adverse scenarios where inflation, interest rates would continue to rise, where we'll have a correction on the property market and escalation of the geopolitical tension. Such scenarios are possible, but they are not the most likely and are not the ones on which we form our predictions for 2023. With that, let's look now at our guidance for 2023. Credit growth first will be in line with the quota that we will receive from the State Bank of Vietnam and will be most probably in the same ballpark as in 2022. On cost of funds and NIM, we anticipate again short-term pressure, followed by improvement in the second part of the year. And therefore, all in all, on average, across the whole year, we expect the NIM to be comparable to 2022. And from there, the NII growth rate should be equivalent to 2022, and the same should apply to the fee income, with again a gradual acceleration through the year. For CASA ratio, we clearly hope to grow it again in 2023. For the cost-income ratio, we will aim to keep it close to the mid-30 level, which is our medium-term guidance. And then the non-performing loans should stay broadly flat, but for the uncontrollable impacts, of course, of the credit bureau. And finally, as we progressively complete the reversal of the provisions that we had prudently booked during the COVID pandemic, our credit costs should normalize and therefore get closer to the long-term trend. So this concludes the financial part of our presentation. I will now hand it over to Jens for a quick recap of how we think of our performance and most importantly of our strategy ahead. Thank you.
Thanks, Alex. So to wrap things up and maybe as a bridge as we go into the Q&A, clearly the fourth quarter has seen quite some challenges, I think, for the entire banking system, and some of the key businesses and some of the key areas and we are operating in clearly has been affected. And liquidity, which started to become very, very tight, and especially also in the interbank market, and still the uncertainty around bond market, real estate market, and we all expect that actually to be kind of and going and having some pain for the first half of the year. But again, I think we're clearly seeing that the market conditions are improving. Again, some of that will be a little bit outside of our control and also of the control of Vietnam, because we will see how global forces are playing out. And as we have seen in the past, Vietnam and the banking sector in Vietnam, of course, is not unimpacted and unconnected to what's going on globally. So that is a little bit of uncertainty which we still need to work with. But again, overall, we still expect an improvement in the second half. The asset quality clearly is, as we mentioned, remains very strong. And so the NPL, the core NPL rate at 0.6% is still one of the lowest in the industry. And again, we look through the book very, very carefully, and also in light of some of the recent events. And we still maintain that this reflects the true risk of the book. In terms of profitability efficiency, we are still ahead of our long-term strategic plan. And we always went back and said, even from some areas like market valuation, and we really basically rather looked into what are the core financial numbers on which we will be performing. and then the market will actually judge the multiples. But if we look into all the key areas when it comes to profitability, return on assets, return on equity, equity as a measure for also price to book, we are clearly in line with the financial plan. We're actually ahead. So even 2022 or 2023 will not change that. And we've seen momentum on customer acquisition at the second half. Clearly, once the app was over its infancy problems right now, and we're seeing very strong performance, we're seeing very, very good customer feedback. And so we are much more confident right now to scale up that customer acquisition, and we will look beyond the 1 to 1.5 million per annum customer increase, which we have seen over the last couple of years, and for this year. And then if we think about our medium to long-term strategy, because there have been questions around, and are we still feeling that the focus which we're having on the affluent, mass affluent, on the real estate market, wealth management, even despite all these kind of events happening, is this still intact? The answer is yes. It is pretty much intact. The secular trends are there. We still believe that we have a competitive advantage, and we're pretty confident that these markets will be coming back. And again, we have enough diversified income streams to make sure that we continue on our current strategy. So what do we need to do? Clearly reignite the customer momentum. And again, I think we're not going into too much depth with it, but of course there are two elements to it. One is we really need to get more CASA and as an absolute number, but a lot of the current drive down in the CASA ratio was also because we just acquired a lot of term deposits and probably shifted away from a wholesale banking market and into customer funding, which again was the right thing to do given the current situations. But again, we just grew in the last quarter our term deposits by 50 trillion, and we're probably continuing that during the first months on that growth trajectory. And the key reason was just in order to be in a situation like that completely on the safe side. And again, as I mentioned several times beforehand, for us, it's always a question just not can we actually build up customer funding, it's just a question of the pricing. And therefore, we took the decision to basically bring it up from 2.9 to 4.1. But again, it's also something which we can cut back if we see that the situation and the tightness of the overall liquidity situation is kind of coming to an end. And therefore, we're not taking anything away from the 55%, but clearly we need to work on this. There's no question. And secondly, we clearly want to leverage more partnerships on the digital channels. As I said, we grew the book roughly at 1 to 1.5 million. We need to grow faster. And given the fact that the system is right now stable, I think we can use our digital platform right now really as an advantage in order to accelerate our customer acquisition. And the third one is fee growth, and that is very clear. We need to make sure that we continue on our 20-25% per annum growth trajectory. And you've seen even this year with IB, which was one of our core drivers in the past, we're still maintaining that 25%. So with IB having been firing from all cylinders, we would probably be rather in the 40% growth range. And so again, we continue on that, but we need to make sure that this is really working. So there's a lot of investments which we did in order to create much more experiences where we can reach out to customers and on the digital channels. And so we have announced a partnership with the leading digital marketing platform in the world, Adobe, to bring that full suite of capabilities into the Vietnamese market as the first bank. And so that should get going in the first installments later in the later part of this year, which will allow us to reach out to customers very, very differently and therefore drive more fee growth. But then we will also create much more differentiated wealth management experiences. I think there's a lot of things to be learned from the current development. And if we think bond market, as Alex has said, we really welcome professionalization of the bond market. Even if it hurts in the short term, we believe in the long term it's exactly the right thing to do. But we believe banker and deposits, investment products, etc., all need to come together to much better wealth management proposition, and that is clearly something we will continue to push with our tiered offerings. And then last but not least, I think we just need to stay very close with our existing customers. For us, most importantly is that in the current liquidity situations, which were tight for everyone, that we stayed close to our customers, that we provided the liquidity, that we have enough funding in order to make sure that all the credit demands within our credit quota can actually be fulfilled. And for us, it was very clear that the entire credit quota which was granted by the regulator, we took that completely to our customers, and we've done this in the past and we will continue to do so. So again, and even if there's liquidity pressure, we're securing enough liquidity to be there for our customers, and we're pretty sure that as markets will normalize, that will actually be rewarded, and as people have seen who stayed with them during the crisis. So again, a lot about funding and a lot about maintaining what we are doing. But again, I'm pretty confident that we will actually contain our growth momentum. And as I said, first half might still be kind of rocky, but let's say despite any unforeseen circumstances where the global economy would completely deteriorate or anything else would happen, and we really think that then the second half already will see an improvement, and therefore I think the guidance in line as what was provided by Alex should still get us on a good trajectory for that year. So with that, maybe I stop here and then hand it back.
Thank you, Jens. We'll take a 10-minute break and return shortly after 3:30 for the Q&A session. Please submit any additional questions to our IR team using the QR code or email address at the bottom of your screens. Welcome back for our Q&A session. We'll start with question number one, is from VietCap, SSI, and a few other investors. Can you share what is TechcomBank's view on the 2023 banking sector outlook, particularly in terms of interest rates, FX, credit growth, and credit demand, given this high interest rate environment? And this question will be answered by Alex.
Thank you for this opportunity to shed a bit more light on our economic forecast. So first on GDP growth, I covered it during the presentation. We expect GDP to grow around 6% during 2023 due to the impact of the higher interest rates, but also taking into account a strong momentum in 2022. With regards to the FX rate, so we expect strong net FX inflows in 2023 from the rebound of the tourism sector, as well as a more attractive interest rates in VND compared to the US dollar. So as a result of that, we anticipate that the dong might appreciate a bit, say by 1 to 2% in 2023 compared to the US dollar. On credit, so as you know, the banks did not use up the whole quota that were given by the SBV in 2022. So this shows something around the growth of credit in 2022, and therefore what we can expect for 2023. Overall, we estimate that the growth of the credit volumes in the banking sector in 2023 should be largely comparable to 2022, if not a bit weaker, let's say 13% instead of 14%. On deposit, as I mentioned earlier, we anticipate that the growth rate should be a lot higher in 2023 compared to 2022. As the SBV starts again to buy FX, the SBV also extends its support to the banking sector, and as the government increases its public spending. So overall, this should allow interest rates on deposits to moderate by at least 50 basis points for quoted rates. So that's what I would summarize. That's how I would summarize our forecast for 2023.
Thanks, Alex. The next question is for Jens. What is management's view on the real estate market in 2023, particularly in segments that TechcomBank's customers mostly operate, i.e. the high-end and luxury, given the current high interest rate environment, which may continue in the full year? And it's affecting both developers and buyers in terms of borrowing costs. This question comes from Eaton Vance and Schroders.
And thank you for the question. So let's start probably with the first one is, and I think we're still maintaining that the overall real estate market is still a growth market for all the secular trends we talked about in prior quarters, and I think nothing has changed. So I think the question really probably rather looks into what happens in 2023. So right now, what I would say, especially if you refer to the higher end market where we are active in, it's just relatively clear that there's a lot of uncertainty, right? And there's uncertainty because there were certain effects and impact, especially on the Vietnamese market. But then there are still overall economic and recession going on globally. And so it's just a lot of noise, right? At the same point in time, interest rates for very safe and parking money for a safe period of time was actually relatively high, and kind of up to 10% for 6 or 12 months. And at the same point in time, that of course affected mortgage rates. So everyone, I would say, was just and is in a holding pattern and just basically try to understand what's going on. And I think that is true for every aspect of the market. That's also true for the high end. And as I said, we expect that probably to continue and for a little bit. And for example, if you have money right now locked in for 6 months, for 12 months, you cannot easily unfreeze that. And if you're saying there's still unclarity of how the Fed will actually work the markets, you probably still hold for a little bit. If you're saying interest rates might be coming down, you're just waiting, and nobody is in a rush. And therefore, again, I think, and that's when we're saying we will probably see rather sideward movement, right? It's not like nothing is happening in the market, but it's not happening at the accelerated pace we've seen beforehand. However, then what is happening in the second half, right? And if we assume GDP growth around the world is actually picking up, if we see that the interest markets are coming down, and so everything is coming down a little bit, and so that means actually your safe haven deposits are coming down, which also means people looking to other asset classes. That means also some of the other positions start recovering, means your portfolio, which were invested potentially in stocks or bonds, starts coming back and is appreciating. And the overall interest rates are actually coming down, and because there's more liquidity in the market, I think people will start looking back into buying and into investing. And as we said, 70 to 80% of mass affluent customers believe that actually investments in real estate is one of the core asset classes they want to hold. So I think we're going back to people looking into that. Will they go back with the same frenziness as before? Maybe it just ticks up a little bit, but especially in the high end, I think that's probably where things are coming back potentially a little bit faster. And because to a certain extent, their question about investing or not and was not so much depending actually on the interest rates for mortgages, because we saw always a huge amount of prepayment where people were basically just using the interest subsidized period of 1.5 years, and then after that basically started paying everything down. So I think money is there. It's really just basically saying take a wait and see perspective. Things are not running away, but as this starts going back, we believe actually that this market come back probably stronger than the other areas, because this is still part of the population who has the assets, who has the interest. So with that perspective, again, first half rather sideward movement, second half we expect it to come back. How much? And I think that is unclear. Again, I don't think we see probably the frenziness of the first half of 2022, but rather going back to normal developments over the cycle, but clearly an uptick to what we've seen over the last 2 quarters.
Thank you, Jens. The next question is for Alex. Could you share your assessment of the 23 to 24 bond market outlook, particularly the default possibility and spillover effects on loan demand and the real estate market, with real estate developers being the largest bond issuers in recent years? This comes from Joe at ViaCap.
Yeah, thank you, Joe, for your question. And I agree that it's an important driver for us. So first, if you look at new bond issuance in 2022, so the overall volume was down 63% year on year. And actually, there was no new bond issuance during the fourth quarter. At the same time, we believe that the investors now have a better understanding of the risks inherent in this product, and they are also more keen to differentiate the quality of the underwriters and issuers, which we believe is going to be beneficial over the long run. Now, although the bonds issued and originated by TechcomBank have proved very resilient so far, other bonds in the market have been affected, and more generally, issuers are still trying to figure out the impact of the new bond rules. So for all these reasons, we expect continued weakness in the bond market, at least in the first part of the year. And when we build our own planning assumptions for 2023, we are relatively conservative and anticipate that the bond origination and the bond distribution volumes will not rebound above 2022 levels. So in other terms, will remain below 2022. So when we communicate on a fee growth target of plus 20% roughly for 2023, this target already includes the impact of weaker activity in the bond market. Therefore, the growth will have to come from other areas.
Thanks, Alex. The next question is also for you, comes from UBS. What do you expect for the credit quota for this year? And does the criteria that's set in Decision 1 by the SBV positively or negatively affect TechcomBank's credit quota consideration for this year?
Yeah, and thank you for this specific question. Like every year, the size of the credit quota is one of the main question marks. To address the specific point of your question around resolution 01, so the reality is that despite this resolution, the governor of the central bank will retain a large latitude to determine the allocation of the credit quota. The rules used to allocate the credit quota are not disclosed, and therefore we cannot really comment on them. That said, our expectations is that the application of the new policy in 2023 is going to be neutral for TechcomBank, if not slightly positive. So overall, as I mentioned, we expect the credit quota granted to TechcomBank to be in the same ballpark as in 2022 when we received 40.5%.
Thanks, Alex. The next question is also for you from Hung of ACBS. Regarding asset quality and NPL and how TechcomBank manages its asset quality and CIC-induced effects, what is the base case and probable range of NPL outcomes for fiscal 23, and what would be the corresponding credit costs in these cases?
Yeah, thank you. And this is also an opportunity for me to shed light on an area, of course, which interests many of us around this call. So I touched on it, and Jens mentioned it as well. Right. So if we look at the bank only, and if we exclude the impact of the credit bureau, then our NPL stayed broadly flat and below 0.6%. If we include the impact of the credit bureau, and again leave aside TCBS, then our NPL increased to 0.7%. So therefore, the impact of credit bureau is around 0.1%. Now to your very interesting question around what happens with the exposures which are classified as NPL because of the credit bureau. So historically, first, around 20 to 25% of our NPL comes from the credit bureau. So in other terms, relate to exposures which are still current in our books, okay? And then from experience, only 30% of this exposure therefore later turn out to also become NPL in our own books, only 30%. So this shows that essentially the fact that we have a strong collateral against our exposures allows us to have a lower delinquency behavior from our customers. Now to your other question around what could happen in an adverse scenario. So an adverse scenario typically would be a situation, as I said, where you will have continued increase in interest rates, where inflation would go out of control, where you would have a correction in real estate prices, where you would have potentially an escalation as well of the geopolitical risks. Then in such a scenario, we estimate that the NPL could be higher by around 50%. So let's say in the base scenario, NPL stays stable at 0.9%. Then in an adverse scenario, it could increase to 1.4%. So this gives you a bit of a range. In terms of credit cost, I mentioned that we expected some normalization of our credit costs that were very low until now due to the reversal of the COVID provisions. Going forward, they will increase and go back to what we consider the normal run rate through the cycle, which is around 0.5 to 0.6%. So that's for our base case. And then again, in adverse scenario like the one I described, the credit cost could increase to maybe 0.9% or 1%. So that's, again, the range I could give you.
Thanks, Alex. Next question is from Pon from RBC. Did the bank have to write off any corporate bonds in 2022? And does the bank expect any NPL formation from the corporate bonds and associated provisions for these bonds in the 2023 estimated credit costs?
Yeah, let me, switch on my mic again. So the short answer is no. We didn't have to book any write-off on bonds in 2022. Provisions on our bond portfolios, now talking about provisions and not write-off, provisions on our bond portfolio in 2022 were very moderate, right? Usually, bond issuers, you would not see a lot of special mentions on bond portfolios because bond issuers have to get the consent of all bond holders prior to rescheduling the cash flows on a bond. Therefore, when you have a bond moving to special mention, usually it is because the same issuer, you have a loan from the same issuer which has been rescheduled. And the impact in any case on our credit cost is very moderate because it would only be calculated on the net exposure after taking into account the value of the collateral. And as I said, all our bonds are secured with collateral. So for 2023, we expect the provisions on the bond to also remain extremely moderate, so in the same ballpark as in 2022.
Thanks. Next question is for Jens from JP Morgan and a number of other investors, and it relates to CASA. Jens, could you comment on why CASA was down in absolute terms and also in the ratio? Was it due to competition? And what can the bank do to reverse this trend? Do you still expect 55% by 2025 year end?
Yeah, thanks. Thanks for the question. And as I said beforehand, there are certain things which I think we should not sugarcoat, and then I think there are some other things where I think we need to put into perspective. So I would take the overall number, and especially on the retail side, we definitely didn't get the growth we wanted to have and which we planned. And I think that was a combination of two things. One is clearly the app stability in the beginning of the year, and actually it has just cost us. And I think clearly that should be and coming back right now as it's stabilized and we get more customer on the platform again. The second one is, and clearly for us, for our customer base, we have a large, or not a large number, but a significant number of customers who are holding very significant amounts in CASA for continuous investments in different asset classes. So this is really rather holding liquidity to invest in the bond market, stocks, real estate, and there's a constant churn also of these assets, and therefore CASA is really handled at a liquidity account. And then as the markets were start freezing, that money was pretty much parked into term deposits or were actually going into assets, especially in the beginning of the year, as a lot of the money was start flowing into mortgages. 30%, 40% down payment is still coming from, still required, so that amount was actually going out. And so from that perspective, and clearly we need to do something, I will talk about it, right? And what exactly we have in mind. However, there's another element, and I think that is rather the ratio. And if you look into the numbers, which again we are showing, is that you see actually that the way how we managed our funding was pretty much like we kept actually our term deposits relatively stable. A lot of growth came through CASA, but then also we used actually an interbank funding. And then in the fourth quarter, when we really saw that there was very, very tight liquidity situations, and we basically just decided to make sure that we really needed to ensure that there's enough funding on the book, because nobody knew exactly how the situation would develop. And I made this point beforehand, for us, this is rather a question of pricing than a question of are we getting it or we're not getting it. And there were some even rumors in the market like, or is it liquidity crisis? I think just as we said before, and we are conservative. So when these things are happening and when we saw that the money market and the interbank market were tightening because of events surrounding SCB, we basically started to really take up funding. And what you see is most of the funding were really coming straight from term deposits, and which to that extent we never tapped in the past because we actually did different sources of funding. But that's the fastest way to mobilize. And so that is what we mobilized up to 50 trillion in a quarter, and even the first months of 2023, and we mobilized a lot of this funding. And that is a decision we took. And of course, that decision we can also revert once we're seeing that situations are kind of calming down, which would, again, from a ratio perspective, and CASA as a percent of total deposits, actually would start swinging it very much back. So there's something which comes from losing CASA deposits. The other one is just from very, very rapidly shifting the funding side. And that is exactly because we wanted to make sure that in a situation where the overall deposit were growing not very much, so overall growth was 8% in the overall market, and we grown at 14%. If you see the numbers, especially in the last quarter, we just really stepped up quite significantly. And that is driving, at this point in time, the very sharp decrease in the CASA ratio. However, as I said, we need to, as we start bringing the funding mix a little bit back in line, we still need to work hard on making sure that CASA overall as a number grows. And there's a couple of things what we're doing. First one is, as the markets are coming back, especially for wealth management products, bonds, funds, and we need to make sure that we have very strong offerings so that people are dealing and investing through us, which means that the liquidity funds, when they get invested, divested, etc., that they're actually staying with us, because that is a big amount of CASA for us in the past. So our wealth management proposition will define how much we can actually get on that side. The second one is, I think we are still not completely using the amount of corporate CASA, either corporate banking, business banking, and our propositions are much stronger. And again, I think we need to be much, much better in strengthening collection capabilities, developing cash payment solutions for corporate customers. And there's a lot of effort which we're putting in. And again, we hope that this will actually also add, not just on the retail side. And then we need to ensure that in the partnerships with our tiered proposition, as I said, we need to just grow our customers much more. And as these new customers are coming in, we need to onboard them and need to create the possibility for them to become main operating accounts. So if we're not growing at 1.2 million, but 2.5 million customers, again, that will actually start getting us a very different CASA footprint. And then all the partnership agreements we talked about should actually help as well as leveraging our digital business model. So there clearly are some market trends which will help. And as I said, as we start rebalancing that in order to overcome some of the immediate shortnesses, you will see that some of the ratio numbers will probably go back relatively quickly. But our real focus is making sure that the absolute amount is going up. And again, we probably didn't spend as much time as we should on really making sure that we have superior value propositions. But the whole bank is right now and very focused this year in order to ensure that this is actually coming back again. So again, for us, and because the question also has been around, are we still maintaining the 55%? Yes. And we are clearly still seeing the 55%. We've grown in 1 year up by 10%. So this is not unreachable. And again, I think it just really comes back for us and making sure that we have the right propositions. And as well as then some of the market situations as they calm down, that we will basically shift back into our normal gear of operating. But then again, the numbers should be going up again.
Thank you, Jens. Alex, next question is regarding NFI. If the worst was in 2022 for bonds, do you expect to see resume growth in 2023 for bond fees? And then do you also expect that non-bond services to keep the kind of 20-25% growth in this year and beyond? This comes from Warwatt at CS.
Yeah, thank you. And I agree, it's a very logical question to ask. I believe I covered most of the points already. So first, on the first aspect, which is whether or not we have seen the worst already in 2022 on the bond market, our expectation is actually that origination and distribution volume might actually be lower in 2023 compared to 2022. And as I said, that at least the default assumption on which we are basing our plan for 2023, because we want to be a bit conservative in this respect. Obviously, we could be positively surprised, and we would be delighted if this happens. But by default, we are basing, as I said, our plan on an assumption of 2023 being even weaker than 2022 on the bond markets. For the reasons I mentioned earlier, investors needing time to absorb and reflect on what happened in 2022, seeing also what are the issuers and the underwriters which prove reliable, and issuers on the other side having to figure out the impact of the new rules. But as I said, when Jens and I communicated on our free growth target for 2023, this forecast of continued pressure and weakness in the bond market is already reflected in our plan and our assumptions.
Thanks. Next question is for Jens from Grandeur Peak. What are the key growth drivers in 2023 for TechcomBank, and what are the battles the must-win battles for you? And then what are the key risks that you are seeing this year?
Yeah, thanks for the question. So, and let me probably stress some of the points I made already. So first one is NII, very clearly, we need to drive CASA, and a product which is kind of called BAULOG, certificates of deposits, which allowing liquidity placements between 0 to 1 month. So I think we need to really strengthen our positioning, because as markets are coming back, as people want to invest again in other securities, I think we see probably a little bit like what we've seen before, that term deposits and the short term might be interesting, and the 6 months to 12 months not so much, and people rather want to have a relatively good yield for products or for money which they're just keeping there in order to make investments. So we need to basically have liquidity offerings which will actually give us CASA. We need to bring, therefore, with that, the cost of fund down while maintaining relatively high NIM. So we need to make sure as the portfolio reprices that we're actually repricing accordingly. But then also we continue the diversification of our assets, and we also need to make sure that as we start getting into retail, that we have the right mix of rather high-yielding products and lower-yielding products, so that overall we actually have still the right risk-adjusted returns. So I think that's on the NII side. On the NFI side, clearly We have done actually quite well. We need to continue on that. Banker still is an area which we have not exploited to the level we want. And so I think that clearly is a big area and we want to push. We also need to still reposition, I think, a lot of the wealth products. I think there is still a lot of kind of right now hesitation thinking about bonds and thinking about funds and all of that. These are still products which are desperately required in the market, and we still believe that is what customers actually really need. And we are leading in that. We just need to make sure that we're actually building these propositions and educating customers sufficiently so that they really understand why that is the right mix in their portfolio, and we need to just offer that. And then for the corporate customers, I think we still need to invest in our digital platforms, making sure that we really have leading offerings around FX, LC, BG, and a lot of cash management services. Next one is we need to drive new customers to the platform. Again, as I said, given that more and more customers can be directly onboarded digitally and all of that, it is not a question of branch presence. It's much more a question of the platform, easiness of interactions. And as Alex said, we have one of the highest rated mobile applications. So I think we should drive much more customers onto these platforms through our own activities, but also with partners. And then I think at the same point in time, we need to just be very careful that we're managing cost and as well provision expenses. And so they are not the key growth drivers, but in order to make sure that PBT remains at very, very healthy levels, we need to work on both sides of the P&L. So I think that's rather what we will do and what we are focusing on. And if you look to the risk, right, again, I think there's risk within the Vietnam market, right? And so we need to understand what's the market liquidity. I think there was intense competition for funding as this, we set the forecast is we actually have much higher deposit growth, so hopefully that will come down a little bit, but again, you never know. The bond and real estate market is important for us. So if that continues to remain soft and longer than what we expect or what we have our plans, then that might actually put some downside to it. Overall, customer confidence is probably still a little bit dampened. And so again, I think that needs to come back a little bit outside of what we can control, because especially if we think about for an export country like Vietnam, that will also depend on overall global demand. Is that coming back, which would lead back again to employment, etc. And then I think we still have these recessionary trends globally, but also still probably some pressure on pricing, and so some inflationary pressure. But again, if you ask me, I think probably that would rather be a continuation of the environment which we have probably seen in Q3 and Q4. And if that would continue for the full next year, that would probably be the downside, because we already factored in that the first half might actually still look a little bit more like Q4, Q3, and then what we had in Q1, Q2.
Thanks, Jens. The next question relates to the 5-year targets that the bank set at the end of 2020, or about 2 years ago. What is your expectation? Do you need to change any of these 5-year targets? And what are the key risks to achieving these targets? This comes from Daiwa.
Yeah, thanks for the question. And as you can imagine, and that is always, I wouldn't say heated debate, but again, I think we're looking at this very carefully, and especially as part of the annual plan, we always just not look into next year, but in the years to come. So at this point in time, we don't see any reason why we would actually deviate from the current strategy, and therefore also from the targets we have set. let's say return on equity 20%. We're roughly at the 20% mark, and we still assume at a capitalization rate of 15% that we can hit actually the 20%. Sometimes it's higher, sometimes a little bit lower, but through the cycle, and that is what we assume. And NFI to TOI, actually we grown up this year because NFI grew faster than NII, and therefore NFI as part of total TOI and actually increased. And again, we still believe, as I said, there are areas where we can have much more growth than what we've seen in the past. And what we need to do is we just need to outgrow our NII, and that is anyway required in order to actually bring return on equity, return on asset up. And CASA, we talked about it. As I said, I think we can bring that back to the 55% ratio. The 20 to 25% growth trajectory, and some of that is, of course, always there will be a question of what's your credit and quota and etc. But again, for me, it's much more a TOI question of can we actually grow TOI at 20 or 25% in a normal environment. And again, at this point in time, we're still pretty much exactly on where we wanted to be on our overall financial plan. So if I look into 2023, the numbers we're looking at is exactly where we wanted to be. We went a little bit faster in the years beforehand. We are a little bit slower this year, but we're actually still completely on target and trajectory. And then it comes to market cap. Market cap ultimately is a multiple on book capital and on earnings. And we're ahead on earnings and we're ahead in capital. So the real question is, will there be a kind of a market cap and a multiple on the book, for example, around 2.5, or on the and price earning of, I don't know, 12, 15%, which is in line what other markets would be seeing. And again, I think the Vietnamese market still is very much undervalued. And it's probably one of the lowest and most undemanding valuations you have in this part of the world or in the world as such. So there's no reason to believe that over the next 3 years, as Vietnam continues to be actually on the forefront in terms of overall growth, if still all the reforms are taking place, that there should not be a re-rating. And we don't need to be re-rated to the level of an India or Indonesia, and it's even half of that, and to be somewhere where Thailand or Malaysia was, and when they were entering these kind of stages, would actually be good enough. So from that perspective, no. And the strategies are right, and the segments are correct, and what we want to do in terms of digitization is correct. I think it's a question of execution, and the numbers, as I said so far, are completely on track or even ahead.
Thanks. The next question is for Alex from JP Morgan. The special mention loans increased sharply in the quarter. Could you comment on where it came from, which customer groups and which segment, and which direction you would expect it to go, whether it goes back to current or into NPL?
Thank you. Totally recognize the interest in this question. We covered it actually in the press release. So we were relatively specific on what drove the increase in the special mention loan. It relates essentially to one project, so it relates to the wholesale banking segments. And the driver is essentially the rescheduling of the payment cash flows on this project without extension of the final repayment date. So obviously we looked at this exposure quite closely, and our assessment is that the economic fundamentals of the project are strong. The collateral held against the exposure is strong, and we expect the loan to go back to bucket one, it means current, at the end of the workout period, and most probably this year. So we should not incur losses in relation to this exposure. And then beyond that, as I mentioned earlier during the presentation, our forecast for 2023 is for NPL to remain broadly stable compared to 2022, around 0.9%.
Thanks, Alex. The next question is for Jens. What is TechcomBank's strategy as the bank switches its focus to retail lending?
And thanks for the question. Maybe there's, if I would probably phrase it a little bit differently, I think we're not switching focus to retail lending. I think we are implementing right now our intended move to strengthen retail lending. And if you go back to what we said in the IPO, and we're just very consistent that we said is we really think about banking as a value chain. So we are working very much with high-end developers, and we are interested in working with them because they are bringing products to the market which are especially sought after by affluent customers and mass affluent customers. And they are taking loans as one of the core products which allow us actually to bank with them. And as they start getting mortgages, we actually have a chance to upsell them, cross-sell them, and really get from one asset class into multi-asset class and really develop a broader proposition for them. So therefore, nothing has changed. What you're seeing right now is that some of these developments, which usually have a gestation period of 2.5 to 3 years, right now basically start coming to fruition, and people are selling and the units and customers are buying it. So therefore, the idea was always we have 2 to 3 year kind of development products, high-end projects, and then we give it to customers, and customers basically start building up the portfolio over time, and we convert 3 months, 3-year corporate loans into 7, 10, 15-year mortgage products. So that, I think, is continuing, and that's working. Have we seen all the upsell and the cross-sell? Not yet, but again, I think the fact that in some of the markets, our market share in terms of overall customers, not wallet share, but customer share, and customers in that segment in Vietnam who are banking with us is above 50%, clearly shows us that this strategy is working. And so that credit rotation from corporate into retail is just what we are continuing to do. And we will put other products on, especially, let's say, for example, credit cards and all of this, but it always follow these customer needs. So therefore, the strategy is not really, as we said, and we're switching it. We are just executing right now on what we said, and you should just expect to see more of that as we go through the value chain, and as I said, as we rotate 2 to 3 year corporate exposures into longer term and retail exposures, and then start adding additional and retail credit on top of it.
Thanks, Jens. The next question is regarding competitive positioning. Previously, there was a big gap between TechcomBank and other private banks in terms of profit after tax. It seems like some of these guys have come closer. Could you comment on some of the reasons for this closing of the gap, and how would you maintain the edge going forward? This comes from Tang at Maybank.
Thanks for the question, and following my normal approach in all these other analyst presentations, I will not comment on the performance of other banks. And I think they have their analyst presentation, and you probably need to talk to them. And I think it's I congratulate them if they show strong performance. So let's look into what we are looking at. We're looking actually mostly in terms of efficiency measures. So the overall PBT is one number, of course, but it's the question of return on equity, especially on an equity base, which is 15% and CAR compared to a much lower industry standard. It's return on assets, etc., where we still try to have a market-leading position. And if you take that to the side, then I think the question is, where is every bank standing in a cycle? So, and we had kind of, if you look over the last over the last 5 years probably, or something like that, right? We probably were at maybe, I don't know, 15 trillion TOI. We are now at 40 trillion TOI. So we had a very strong growth phase, where others were a little bit slower behind because of investments we took. And we will right now do these investments as we speak. So, as we said, we continue on an investment trajectory of roughly 20%. And we will continue to do that in order to gain actually additional revenues going forward. And have we completely optimized the result this year? I already talked about the CASA side, which clearly is not there. I think there is room in Banca. And clearly we have been set back by our exposure to the bond market and one of our core areas for NFI. But again, I think when it comes to the efficiency ratios and all of that, we are actually still performing quite okay and quite in line with what we have expected. So, and again, efficiency-wise, we still think we top the industry, and that's clearly where we want to be. And secondly, again, I think we are right now in a different cycle, and this year probably a little bit slower. But again, then we can also start moving up again. And so for us, it's really more a question: are we in line with where we wanted to be, and what we have set out to do, and that we are.
Thanks, Jens. The next question comes from Ruchir Desai at Asia Frontier. Could you comment on the draft amending Decree 65 and how it impacts your view on the bond market and the bank's bond-related credit and fees?
Well, thanks for the question, but probably you will see me as much looking into it and probably assessing what might be coming out. I mean, of course, we're giving feedback into that draft, but what ultimately will come out, I think, is very unclear and still undergo further revisions. It's very clear that the regulator is listening to feedback. I think there is very clear guidance from and also the Prime Minister that the corporate bond market is important, that we need to make changes in order to overcome some of the situation we have right now, especially the tightening and access to funds for the real estate sector, which is a very important sector for the overall economy. So again, I think to a certain extent we hope that this decree will actually address some of these issues, but once we have not seen the final output, it's very, very hard to comment on it. In any case, we believe that it will be helpful to the market, and therefore it will be helpful to others and to us as one of the key leaders in that market. But when it's coming and how it's coming, I think that is still to be seen. Again, our plans are not assessing right now that there will be major changes, and especially when it comes to potentially some of the restructuring of bonds, etc. But again, even from our side, that might not be also the most relevant for the bonds we have issued. But we know that others might be in a different position, and then of course it affects the overall market. So, and it might, whatever the decree might be, it might be less relevant for the immediate actions we can take, but for the market as such and the impact on the market, and of course, we hope that all the feedback from the industry and from different partners will actually be incorporated, and we will see this relatively soon. But as I said, I think all the authorities, the regulators, are clearly understanding it and working on it.
we have time for two more questions. This question is for Jens from Tao at VN Direct. TCBS's market share was down to 3.7% in the fourth quarter from 5% in previous quarters. Was this due to lack of customers' confidence? And how long do you think that it would take for this to resume?
Thanks for the question. So the first one is, yes, there was a reduction, and mostly this reduction came from a reduction in our offering of margin lending. And I come back to the point, we are rather conservative. So, and when we saw and some of the developments, and especially also on liquidity, etc., we decided to just basically be less open in terms of how we're extending margin credit, and customers reacted to that, and we were expecting it, and that is okay. But we felt that was not the right thing to do at this point in time, to be very, very courageous. So we believe that we can get back to that if the markets are coming back, and then again we will see an increase in our market share, because in terms of offering, in terms of overall value proposition, there was a reason why people actually went and we got to the 5%. We didn't see a big impact or spillover in terms of the TCBF events, which again, I think from my perspective were managed very, very professionally, because that's the way, even without any precedents in the market, where we needed to find a way, and I think we did the right thing to protect investors. The whole situation there has stabilized, and therefore we, while there were a lot of questions, which I agree, I think we have not seen a major kind of disruption in terms of confidence. And I think also it would be very hard to see that you would get to an increase in 50 trillion in term deposit funding, or continuously even in January, right, if there would be a lack of confidence. So from that perspective, it was really explained by the fact that we were getting much, much stricter on margin lending and cut that down, just because of our risk appetite. But again, once we're opening it up again, I think we're going back on the trajectory.
Thank you. And we'll take the last question for Jens. Could you share more color about the capital increase at TCBS and the current progress for Standards? If TechcomBank is the sole shareholder that's participating in this 10 trillion capital raising, what does that mean for TCBS's IPO plans?
Thanks. So ultimately, as I said, we are still very bullish about the market, right? We think wealth management is the right way to go. There is a lot of room, asset management, and there's a lot of room for creating much, much better offerings. So TCBS is the entity which is leading our forays into that market, and therefore the 10 trillion which we have earmarked is clearly in order to achieve our aspirations. And this will continue over time, and as we get more things to talk about, and as money is really getting infused, and as all the decisions are taken, we will publicly announce those, right? But again, as I said, the 10 trillion were in line with ensuring that we can grab all the opportunities we want, and that is pretty much on track. In terms of, yes, if we are basically then the sole shareholder, doesn't mean that our IPO is off. So first one is, and I made this comment beforehand, we will always look into an IPO if we believe that is value creating for our existing shareholders, right? And at this point in time, I think we have the capital, and we believe that the returns which we can get out of this are higher than if you would right now ask other capital to come in. So from that perspective, and it's very consistent, that I said, if we don't need other capital and we can still fund it and we believe it's good returns, we will actually shoulder our own capital injection requirements. And that's what we're doing right now. Again, that doesn't mean that if things are developing differently, that we might then not again put that money which we have invested and start putting an IPO out. But it was a little bit less in the cards, let's say over the last 1 or 2 years, than people, some also brokerage firms, maybe wanted it to be. But again, the fundamental logic has not changed. If we believe at a point in time that it's better to bring someone in to make it IPO because we believe that actually creates additional value for our shareholders, we will do so. But at this point in time, we believe that investing up to 10 trillion into that market is actually most advantageous for our existing shareholders, and that's why we put the plan forward, and that is why we put it forward to the AGMs, etc. So there's not an imminent plan to IPO, but again, on the other hand, until 2025, there's a lot of things which can still happen. So we will not take it out, but again, it needs to create value.
Thank you, Jens. This concludes the fourth quarter and full year 2022 financial results presentation. The presentation and replay link will be posted on the IR section of the website soon. Please contact the IR team for any additional questions, and we look forward to speaking to you again in 3 months.